Good morning. Welcome to Option Pit Live. I'm Mark Sebastian. I am joined by one, Alicia J. Leslie, the
Good
Queen of the
morning.
Candlesticks. Alicia, non-farm payrolls are out. They come in hot. Uh, December actual 216,000 versus 175,000 expected. The unemployment rate was lower than expected. Slight miss on the labor force participation rate, only 62.5 versus an expectation of 62.8. But all in all, this was not a Goldilocks report. This was a report that showed strength, which kills the narrative that the
Good
market
news is bad
ran on.
news.
Yeah.
Darn,
Good news
too
is
many
bad
people
news.
are working.
Yeah. How dare you work? I want the Fed to lower rates. That's what the market just said.
Yes.
And this kills the narrative that coming out of the market for the month of December was, in my opinion, absolutely ludicrous. The Fed's going to lower rates in March. I don't understand how that happened. But heading into this number, the expectations were near 50% that the Fed was going to lower rates in March. And
I read 70% earlier this week.
yeah,
It should go down.
yeah,
70% is crazy.
it trimmed down this week as the market sold off and rates rallied. But it was completely ludicrous. And this economic data hitting kind of puts a nail in that coffin, I think, that of the March the March rate cut. It's
Rate cut.
absolutely ridiculous.
Well, just an
Yeah,
average person, even someone that isn't into economics or the market or anything, it's already you've yanked us this way, and now you're ready to yank us back the other way that quickly. I mean, only a few months. Nothing is even. It takes time to take effect. Correct.
yes. Higher for longer is what they've said repeatedly, and nobody seemed to want to listen. I mean, they have said that Powell has been bluffing for months and months. Actually, for 2 years, they've said, "Oh, he's going to stop. He's going to stop. He's going to stop." He's not going to stop. And folks, the rates that we're in are the norm. They're
Right.
not unusual. And this is
Correct.
something, the guys working on Wall Street, they're not old enough to remember a 6% interest rate. That's what it comes down to, I think, as a part of it. Some of the old men maybe, but I'm 45 years old and I'd be a fossil on Wall Street in
Well,
the trading community.
let's not
So,
talk about what I'd be.
well,
On to the next topic.
all right. So speaking of which, so on that news, futures down 25 handles in the S&P. The March future is down to 4704, threatening 4700 again. Nasdaq futures are even worse. Nasdaq futures are down almost 100 points, 98 points, down to 1646. Russell futures are down 1.36%, down 26 bucks. And now the 10-year note, this is the one everybody kind of pays attention to. They're down to 111.11, so down over 0.5% on that news. A really ugly move. The long bond is down 1.12%. That is a huge daily move for an interest rate product, down over 1%.
Yes.
Down to 121.16. So VIX rallying on that. VIX futures are also up. So there goes the narrative. So with that in mind, with kind of the breaks that we're making, Leisha, I don't know, were you able to get your charts working or not?
Yes, I have trading view access. So let's look at, now that you just mentioned the 10-year, let me show you my pitchfork.
Yes, let's take a look.
Here is the 10-year. It's followed along this pitchfork pretty well. Bounced off the lowest support. And now the pitchforks are more of an art than a science, but they don't have very many rules, but one rule they do have is if your underlying does not reach the upper or lower bounds of the pitchfork exactly, yeah, I shouldn't say exactly, but it becomes shy of the top here, That's pretty good indication it's going back down to revisit this. That is a pitchfork general rule. And here you can see they're breaking down even more. They just moved quite a bit, actually.
Oh yeah, well that they really did not like
So
that
yeah,
non-farm news. Wages
according
came in
to
hot as well.
this, the 10-year has quite a bit to fall here.
Yeah. I think that interest rates, got a little ahead of themselves. The 10-year got below 4%. The 30-year got below, even threatened, got below 4%. It's back above 4. I don't think it's going to 5 like it got to, but 4.25, 4.5 range seems relatively reasonable. That would be kind of what I would be looking at if I was executing in this market.
Yeah.
All right, so there's that. Let's take a look, if you don't mind. Let's take a look at SPY
Oh,
and the
yes, that's
Qs.
what I was going to talk about with SPY.
Yeah.
I wrote up last night. SPY closed below my 470. Now, 470 is just a more recent, well, it comes back here too, support. We kind of almost made that double top, not quite, but, within a matter of points.
Yeah.
So I had 470 as coming back. It was resistance, coming back is now support. And now we've blown through that, closing well below it yesterday. I think SPY can trade down here to 4. I had 459.5.
Yeah, I mean, well, the 21-day moving average had gotten all the way up to 468.67. We closed below the 21-day moving average for the first time since November 2nd yesterday.
Okay.
And that is so next stop would be the 50-day. Last time we closed below the 50-day, November 3rd. So that was when we got that just kind of roaring rally out to start off November. Really, we had a really strong 2-month rally in the market. But this is our first time below that 21-day in what amounts to 2 months. The 50-day moving average has us at about 452.13. I think that would be a logical place for us to head. Now, what does this mean? I mean, Alicia, it's the first week of January, right after a 2-month rally. How do you think investors should put this kind of into their packet, right? Everybody's out with their 2024 pick, right? Their best idea for 2024. How do investors kind of put this into their basket or into their thought process as they're developing a trading plan or a plan for 2024?
For me personally, predicting a year out has got to be one of the most difficult things. I can see more closely in the near future. I can make pretty good educated guesses. For me, going out a year is difficult. But saying that, I think, yes, I think we're going to pull back here. Do I think we're going to collapse completely? I don't think so. We're in an election year.
Yeah.
And what do we do in election years?
What
Don't
do we
we
do
rally?
in election years? Yeah, we rally.
Don't we rally?
Yeah.
So
Well,
by maybe after the first quarter, maybe after that, we, when there's more debates and more going on, and the I don't know what, the current administration, they're all, I don't want to even get down there, but the market will probably go higher.
yeah.
Whoever's in office, it happens for them. And I'm
This
not
is
saying it's right
America.
or left, it just happens.
This is America. Stock
Yes,
go up.
exactly.
That was our famous one. And yeah, I don't think you have to place too much into this. We had gotten a little overbought. So folks, this is not a run for the hills.
No,
But
a pullback is healthy.
even this rally was not really as broad of a rally as it looks. Yeah, the S&P's at an all-time high, but it wasn't it wasn't every stock. There's still a bunch of stocks. I mean, look at Ford. Ford is still in the toilet. GM still in the toilet. For manufacturers, fertilizers,
Yeah.
and I did an analysis, folks. We can look at this on my chart. I did an analysis of the 11 major ETFs that make up the S&P 500. And this is a year-over-year analysis of all 11 sectors, and then this is the S&P in the middle right here. And what I want to point out is that there's only 3 sectors that actually outperform the S&P 500. The consumer discretionary, that's Amazon. Communications, that's Apple and Facebook. And technology, that's going to be NVIDIA, Microsoft, and the like. I think Tesla's an XLY. Then every other sector. So real estate, financials, energy, utilities, healthcare, consumer staples, materials. Every single one of them underperformed the S&P. So I know that this is not going to last. Why? Look at a 2-year chart. If you look at a 2-year chart, there are only 3 ETFs that beat the S&P, and they're not who you would think. It would be energy. It's consumer discretionary, and what was the other one that beat it? I'm sorry. It's energy, technology, and healthcare, believe it or not. So there are now on a 5-year, it's literally just XLK. So if you were saying one thing, it'd be invest in technology. However, I think this run, even within this major outperformance, it does have moments where it vastly underperforms the S&P. I think XLK is lining up for one of those. The only ETF that's down, the only 2 ETFs that are down 2 years over 2 years. Well, actually, there's a couple now. Real estate's the worst performer. Utilities, consumer discretionary, 2 years over 2 years. Consumer discretionary, financials, consumer staples, they're all down 2 years over 2 years. So it's kind of interesting the way this sets up. You're going to see some rotation, and I think that is going to be the key, which leads us to trade talk, kind of some trade talk. I know we're running a little behind, and this whole theme of these 3 major sectors is the Magnificent Seven, and the face of the Magnificent Seven, like it or not, and I want to bring it back in Leisha and Andrew for this. The face of the Magnificent Seven is Apple. So I want to bring in Andrew as well to kind of chat this up. Good morning, Andrew.
Hey, how you doing, Mark? Hey, Leisha.
Hi, Andrew.
So today's big discussion. All right, we've got people actually willing to downgrade Apple, which I didn't think was possible. Right? Everybody loves Apple. It is the hedge fund hotel. It is where all money goes because Apple is Apple, and nothing bad can happen to Apple.
Correct.
Is Apple still the golden apple, or is Apple the bad apple? Andrew, let's start with you. What do you think? Are you still all gold on Apple, or is it time? Is it rotten to the core, loaded with worms? What do you think?
I'm trying to come up with the right metaphors. It's hard to beat those. I think for this year, the time has passed, mostly because eventually the market will be tired of it not growing. I think the fact that, it was able to kind of keep revenues fairly even when everybody thought things were going to zero was good, I guess. But Apple's done this historically. Everybody ignores it. Then they all love it. The multiple gets really high, and then it sells off like crazy and it drops like 40% from the peak. So I'm not calling for a 40% drop this year, but unless the revenue growth kicks in, I don't see how money keeps piling into Apple. They'll find other stuff.
No, yeah.
So
I
I
don't.
don't think it'll finish up this year, personally.
No, well, I don't know. Alicia, what do you think? What do the charts say anything about Apple on a long-term perspective?
I'll show you Apple. It's made a double top. Classic
So let's look at
rollover.
Alicia's charts real fast.
Thank you.
Charts.
We have a double top at the top of my pitchfork. And that makes sense for it to look at nice rally. Did not make it all the way to the support on this pitchfork. So it rallied all the way back up to the top there. Now we have a double top. I see a little bit of support just below here. So you could get a little bounce off 180. But then from there, I'm seeing here 174, which would be these
Okay.
previous highs.
174 is kind of your where
Make
there's-
it a little bounce at 180 and then 174.
that's where the rubber meets the road. Where's the kind of the equilibrium for this name? Then if it really, where does it settle to, you think?
Well, from 174, we have 162.5.
Oh, okay.
And if it's going to visit the support all the way down here,
That
127.
would be, I don't think it's going to 127.
I don't either.
But
I would say the rubber
162
meets the road 166 to, 165, say.
Yeah, I mean, for all the selling that Apple has had, it still has a price earnings ratio of 29.68. And
It's pretty expensive still.
it is an
relative.
expensive stock. Now, there is still earnings growth, but it's not NVIDIA earnings growth. It's not crazy earnings growth. It is just steady making money. It's steady Eddie. It's a B student, right? It is a B student. It nice and mellow, doesn't talk too much in class, relaxed. But what I think we're going to see with Apple, I don't think anyone here is predicting some crazy selling, but
No.
as it's becoming a really mature company is what you would say. Mature companies have multiples of 18. Now, how does it get to that multiple of 18? A little bit of selling and a lot of time is what I would say. So consider earnings kind of can expand slowly and the stock not rally, and that PE can contract. That PE, price earnings ratio, that's the price of the stock relative to how much money it makes per share. And so if the stock sits and those earnings slowly come up, the PE can gradually normalize. And I think we're going to see that mixed with the stock pulling back a couple of bucks. Folks, what do you think? Are you bullish Apple for 2024? I've laid out my opinion. Alicia's told you what she's seen in the charts. Andrew's laid out why he believes it's not going to have an up year. But what's your opinion? I know we have Apple lovers still out there. It's not the same cult stock that it used to be. I believe that's currently owned by I don't know who. NVIDIA is the current
NVIDIA,
cult
I think,
stock.
would be the one. Yeah.
NVIDIA is the current cult stock. All right. Now, here's story number 2 I wanted to hit on was WBA. And Andrew, this is one you and I keep thinking it's a value. It's a value. It's a value. It's like the kid that, it's like having a kid that just will not, all they can do is fail. Right. Right. Like
Has not been a good, it was great. And now it's not.
It's like having the kid from parents don't don't understand. The one that goes out and, you say, don't drive the car. They drive the car. You say, don't have a party. They have a party. You
Right.
say, get good grades. They get Fs. That is Walgreens.
Yep.
So what are your thoughts here on is it time to just say fat?
Well, I think it's one of those things where like Walgreens, I would say will probably be higher at the end of the year than it is today. They cut their dividends, so that bad news is out. They basically cut it in half. It's still yielding like 4.5%. It was yielding almost 10. And they, they did say, hey, we expect earnings growth this year for the first time since COVID. So I think as a stock, they did really well in COVID, which is one of the reasons why we liked it, right? Because everybody was going there getting their shots and whatever. And then no, and they have all been having all kinds of restructuring problems since then. So again, do I think it's going to be higher at the end of the year? Probably yes. Probably from a strategy point of view, it's probably not a bad put right at this point, but it's hard. It's been disappointing for sure, but I think as a stock, it's probably like a put right, sell put spreads or something like that. Because if the bad news is already out, the stock was down like 10%, and it rallied back it recovered most, or not most, but I'd say like 60% of the loss yesterday. So I think it's worth keeping an eye on, but it is what I would call like a restructuring, it's like a rehab play for a stock. They got to get their act together. But as of right now, it's not looking, it was $20 in December. I think that was the low. So it's not as bad, but it's struggling.
Pretty bad.
May I show you my pitchfork?
Yeah, absolutely.
And it's followed along here pretty well all the way back to December of 18, Andrew. See that?
Wow.
It's just staying in the range. So it needs to break out.
Well, let me show you. That was a pretty big downtrending pitchfork in which it followed completely. So according to this, 17 3/4.
Wow. Well, there you go. So write the 17 puts.
But you do have this you do have this horizontal support there at 20. You're right about 20.
Okay.
These lows here were right at 20.
So Andrew, you just laid out a trade idea. The January, if you want to own Walgreens, the January 2025, a year from now, the 17.5 puts, if you sell those, you will collect $1.15. That's a pretty nice yield to potentially buy the stock for below $17, which sounds great until the stock is 12.
Right.
But
what that would like 5% yield or something, Mark. You get $1.25 on.
That's like an 8% yield on that.
There you go.
Not a bad little sale. If you want to go a little nearer dated, you're getting, let's see, you're getting a 5% yield selling the July 17.5. Those have about 6 months to expire.
That's not bad though. Like 17.5 is.
All right. Now I know
we've said this though before. It can keep hitting lows. We can't think.
It totally can. All right. So let's talk about some trades we like and why. I just wanted to touch on. I want to start with myself. And I've been keeping an eye on Cameco. This is CCJ. My pick for 2024 is mid-cap banks. I think that's going to be the best. If I had to put my money in one thing, it'd be mid-cap banks. But I'm looking, another trade I really like is Cameco. It has been on this. If you want to share my screen, you are good. It's gone basically kind of straight up. It does get these tests of the 50 where it closes a blow, and then it tends to bounce. Well, what have we got in here? We have this nice rally, test of the 50 on a day where the market was really ugly on the 4th. It actually was up. I'm looking for this to make another leg higher. I think there is a near-term bull case for Cameco. CCJ is the ticker symbol. I don't really want to deal with earnings. So if I want to just play this one to get a little bit of a bounce, here's my trade idea. I would look at the February 43 calls for about $1.75. And if I want to do a call spread, I would offer out the 48 calls at 45 cents. Try and put the 43-48 call spread on for about $1.30. But the straight calls for $1.75, I think, are relatively inexpensive. That's my idea for Cameco. Now, Alicia, you wanted to talk about a couple of names real quick.
Sure. Let me show you your chart in CCJ. I think you have a good idea here.
Oh, thank you.
We have a really nice uptrend and it stopped. Here's the median line offering support and these previous highs are offering support. And you have a nice doji day before yesterday and some bullish action yesterday. I agree with you on that CCJ.
Well, thank you.
If it revisits here, it's 49.
All right.
So my original, as far as putting a trade on, was the SPY. I looked at last night, the SPY 467, 457 put spread, 10-point put vertical for about 2.5. We may be able to do that here. We're not, where are we? Is this 466?
Futures have recovered. We're only down about 8 now.
Yeah, I see that.
Yeah, futures have recovered.
I still like that though. It yesterday revisited my 470 and I think we're going to go lower. So I like that 10-point put spread, January 19 expiration for about 2.5. I also like IBM puts. IBM's also come back and retested my median line. I think this is bear flagging here. I think IBM can trade back down to around 152. And last one for the bulls.
Ooh.
Coca-Cola. It's topped out right here, hitting some resistance at this previous high, but you can see we're bull flagging here. I think Coca-Cola can make a run back up here, 61, possibly, yeah, 61, 62. And Coke.
It's been looking good when everything else has been not looking good. Too.
Yes,
it has.
McDonald's, Walmart. To me, those stocks are generally counteractive to the market.
Yeah, counter trend. All right. Well, folks, there are Li Shen Mai's trade idea. Now, Andrew's going to present his trade idea, but to do so, we're going to have to whistle and raise our arm and hail Andrew's trading vehicle. Andrew's trading vehicle, take it away.
So today's trading vehicle will be a SPY strangle. I'll also cover my arm trade at the end. But for right now, we're going to cover a SPY is our vehicle, and a strangle is a combination of a call and a put. So if you guys can show my screen, thank you. So here we are, just a standard option screen, and what I like to set up a strangle as is it's a long call and a long put. If you buy a strangle, if you sell a strangle, you're selling a call and selling a put. But for today, we're just going to deal with buying a call and buying a put. So the first thing is you're like, why buy a strangle? So you want two things to happen. You want the stock to move, and you want the stock to move a lot. All right. You also want volatility to increase if possible. So that means if you're buying a strangle, you're looking at the range of the underlying, so how much it's moving. And you're also looking at how much you're paying for the strangle relative to the range. So that might sound confusing, but it really isn't. So right now, if you look at the Jan 12 cycle on SPY, the at the money call is 350 and the put is about 315. So that's 665 to next week. So the market, again, as an old market maker, I used to take the straddle as basically what I expected the stock to do between now and expiration. So the market's thinking 615 between now and expiration. And to be honest, with this non-farm payroll number coming out, I think that might be a little light. I mean, a little low, especially if, the news, people react poorly to the news and we keep cascading down. However, this market has been very squeezy, right? So that's why I'm looking at the strangle. So we tend to have pretty strong momentum once we get going in a way, especially with some of the squeezes we've had over the last couple of months. So, but right now the sentiment is definitely bearish. So what I would do is I would set up a strangle to lean a little short but own a call to basically stop the trade out. So what that does is that allows me, the trade basically exits itself. So what I would set up is be a little more aggressive on the put. So maybe buy a 465 put for 217, and then come up here and just buy some like disaster call up here at 473 at 126. So my net cost is going to be about $3.75. So if we do rally up all the way to 473, basically my strangle breaks even. I don't, again, now 473 is the top of my expected range, right? So if we just rally up there, I'm probably just going to break even. So from that direction, I'm just looking for a break even. But on the downside, since I leaned a little short delta with my put, if we start to cascade and volatility expands, then the value of my strangle is going to jump really fast. So I set my strangle up in such a way that one direction pays me decently well. The other direction basically stops me out. So, no matter what trade you put on, you got to close the trade. So either that or you have 0 DTs type stuff, and then it expires to cash. So this type of trade basically is you can keep it on for 2 or 3 days and just see what the market does. So my rule for a strangle, I'm going to just kind of scroll down here, is I guess the simple idea is you manage the trade for the number of days you want to stay in and close what pays. So the simple mantra when you trade a strangle is you manage for days and close what pays. So what that means is, so here's a trade hawk, set up on a strangle. So what I'm doing here is, these are my break-even numbers after January, it looks like the 8th. So I don't want to keep my trade on more than till January 8th. That means my dollar risk is limited to 134 bucks on a one lot. So if I buy, this is just buying my strangle. I'm trying to keep my dollar list relatively low to my cost, which means I'm going to stay in less than to expiration. And I know what my basic break evens are. And if we do get a breakout, where we hit that lower number like Leisha talked about, then, I have basically double my money on the trade, at least. That's not a problem. If we just kind of rally up here, I'm just going to, I'll just be breaking even. So the whole idea with the strangle is you're not trading it for your strangle to go to 0. You're just trading it to hold for a number of days. So my general rule is, again, you manage the trade for days. I'm only going to be in it for 3 days, and I'm going to close the thing that pays. A magic area with a strangle is all of a sudden you have a relatively fast move. You close one side of the trade, and then you have the other side for a credit for a potential turnaround, right? Because you're only closing the side that's paying when the underlying stops moving in your direction. And that's like basic strangle management strategy for me. And you also keep the risk of your trade or the loss number relatively small. So you don't have to be, you have to look at a risk graph the right way. You're only going to manage the short end of the risk. You're not staying in it for the entire thing. And I think that's a big fallacy people make when they buy this stuff. They just think, well, I'm going to lose all my money because it's going to go to 0. You're not going to stay in it that long. And normally with a strangle, you will have one side that pays if you are right on, whatever your opinion is. So the last thing I would say is, and the last thing here is I put on an ARM call spread last week. I filled it at the end of the day. It was the January 19, 79.85. I ended up filling it for $1. Now, right now, ARM is down like $6 or $7 from my fill spot. However, what I did was I closed the short contract, the 85s, and I bought 2 of the 69 puts on Tuesday because I wasn't getting, so ARM wasn't going up. So I wanted to keep my risk in the trade down to below my $500 number. So I had, what I did was I changed the delta. I changed from short calls on the 85s to 2 long January 69 puts. So what it did was, and those 69 puts are paying, but they paid, I sold them, I made like $150 on them. So what I'm going to do is I'm going to map the trade out for you once it's closed by this week. But that trade did not go well, at least so far. But if we do get a little pop, I should be able to break even. So that's kind of what I would call that's fixing a broken arm.
I like that.
Fixing a broken arm trade. But it is
That's
definitely
awesome,
not
Andrew.
very good. Hood good, arm not so good right now. So that's fixing my broken arm trade. That will be my my vehicle for next week, so to speak. I'll lay out all the stuff.
Fixing a broken arm. All right. I love it, Andrew.
Yeah.
Okay. Andrew, thanks for stopping by and giving us your vehicle. Any closing thoughts for today before Alicia and I break down a little order flow and wave everybody goodbye?
Oh yeah. Order flow. I always like the order flow part.
You just got Andrew all excited.
I know. Well, it's sweet. Mark and I have done well over the years looking at the order flow. I would say, like, if we have a trend, because we have a pretty strong reversal this morning, I would be a bit of a trend follower today personally. So, the heat's coming out of VIX a little bit, so we'll see if that continues. So, I would prefer the market to fall apart, but if it's not, I can easily become a trend follower and ride the short vol down. So, but
you got to be nimble.
Yeah, you have to be nimble. But that would be my thought for today.
All right. Thanks, Andrew.
All right, guys. Have a good day.
Later.
Leisha, I want to take a look at T-Mobile, TMUS. And we saw a huge order in T-Mobile. A trader bought that was long the January 155, 165 call spread. This trader was long about 16,000 of them.
He did very well.
Huge position in T-Mobile, TMUS. They sold to close at a nice profit. So they sold to close at $7.01. I think they bought it for a couple of bucks. Nice trade.
Very nice.
They rolled it, and they rolled out of the Jan into the February 165, 180 call spread. So they gave themselves an extra $5 at upside, and went pretty far out of the money on those 180s. So they paid about $3.75 for the 165, 180 call spread. They're looking for a big upside move here, folks. So this is a trader that was right. This is the kind of order flow I like. We have a trader that was right, that is closing, taking money, but rolling the position higher. The only way I could like this trade more is if they were levering on the roll and buying even more. Leisha, what do you see in the charts here?
I will show you. It's pretty incredible, actually. Here's my pitchfork, and it kind of wallowed here in a bunch of consolidation for a long time. Begins to break out. The stock likes to consolidate, it looks like, and then takes off. We've closed 3 days now above this previous high, which is bullish. Nice bullish candles here, the 3 green soldiers. This to me is flagging. Your next stop will be 169 3/4. But Mark, look where the top of the pitchfork comes in.
180.
Isn't that awesome?
Yeah, these guys know what these people know what they're doing.
I'd follow that trade. Have you priced any options yet?
I'm looking at it. So you like the trade?
I do.
All right. Well, there you have it, folks. So we on today's show, I gave you an idea in CCJ. Leisha laid out some different ideas on where the SPY could go, where IBM and Coca-Cola could be heading. We talked about whether Apple was good, bad, or ugly. I can't wait to read all your comments about where everyone else thinks Apple is going. Our consensus is maybe not anywhere, or maybe a little bit lower. We're not doom and gloom on Apple.
Right.
But Leisha, what are your thoughts for the rest of the day? Futures are now down 7. So off the highs and off the lows, but down ever so slightly. But the bond market has recovered a little bit. The 10-year is now down. At its low was down about 0.6%. It's down about 0.4% now. So bonds have recovered a little bit. VIX futures are actually down now. But ES has recovered a little bit. NASDAQ futures are down about $25 from a low of down over 100. What are your thoughts heading into the trading day here and into the end of the week?
Well, today's the end of the week. I'm thinking we're going to be down on the day, and down more than I think we could be down 20 on the day.
All right. So Leisha's looking
on SPX.
Yeah, on SPX. Leisha's looking bearish. I'm generally with you a little here, although it's interesting that this rally has been interesting. I'm wondering which of the Magnificent Seven stocks are popping here. Nvidia is currently up about $3. Microsoft is up. You're getting some strength out of the Mag 7. Something that you will see when people are scared. You'll see money pile back into those names. So we could see a little bit of defensive posturing here today, but I'm with you. I think we could be down, and we haven't really had a breakout big down day this week. Like, it's been bearish, but there hasn't really been anything really ugly. We had that 38-point drop on Wednesday, but it hasn't been that bad.
I remember a lot of times people don't like to go home with positions too. So
yeah,
over the weekend,
you could see if we're down, if we retest the lows from the pre-market, we are going to go significantly lower from there.
Yes,
that would be
I agree with that.
But I think this is one of those days where it's worth waiting a few minutes before you pile into any trade for sure.
For sure. My general rule of thumb is wait an hour before you do anything, unless you're exiting a position.
Exit early, exit often. And I unless I have a real high conviction trade, I'm generally not trading in the first half hour to an hour as well. That's usually my take. Well, folks, Leisha, I hope you have a wonderful weekend
Thank you, Mark.
Relaxing weekend. You're in Arkansas, I believe, right?
I am back in Arkansas.
All right. Well, you enjoy all your Razorbacks. I am going to Fredericksburg, Texas today. I'm going to go.
Oh, it's so fun there.
To the wine country, and me and Lauren are gonna have a weekend to ourselves, which we're excited about.
Sweet.
Yeah,
very sweet.
And so, folks, for Leisha J. Leslie, the queen of the candles, I am Mark Sebastian, your only option. This was Option Pit Live. We'll see you next Friday.